Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On today's show, we are talking about how startups should think about raising venture debt versus equity with managing partner of Silicon Valley Bank Canada, Shez Samji. As everyone already knows, there are a few ways to fund a new business to fuel its growth, either through some form of debt financing or equity funding. But venture debt is a little different than traditional debt financing. And in 2020, VC-backed companies in the US alone received debt financing of more than $25 billion, and the market continues to grow every day. On today's show, we talk about when founders should consider debt financing and why it's important to understand all the different kinds of terms and stipulations when reviewing debt term sheets. Shez addresses the differences between short-term debt financing, like lines of credit, versus long-term debt structures, like term debt, and why it's important to never use short-term debt to invest in long-term solutions. We discuss the differences between revenue-based lending platforms like Clearco and Pipe.com, and what are some gotcha clauses founders should look out for. Finally, we asked Shez what are some of the additional benefits of working with venture capital and private equity-focused lenders like SVB on the venture debt side, and what founders should look for when choosing which lenders to work with. Now let's get into this week's episode with Shez Samji, managing partner of Silicon Valley Bank Canada. Thanks for joining us in the tank today, Shez.
My pleasure, Matt. Thanks for having me.
So as I mentioned, today I want to talk about the ways in which startups should think about raising debt versus equity at the early stages and some of the questions they should be asking themselves. You know, as everybody already knows, there's more than one way to fund a business to fuel its growth, either through debt financing or from equity investors. In most cases, when we think about startups, especially tech startups, we default to equity financing as the most debt lenders are not looking to make money on their investments, but instead try not to lose their entire investment. It would be great if you could start us off with the pros and cons of each option for startups to consider when looking at funding options.
First, I want to begin to cheer our tech founders and those wanting to join an early stage company, even as an employee. I think particularly here in Canada, never has it been such a great time to take such a leap of faith. Now, we have a massive amount of tailwinds, be it investment from VCs, angels, and debt providers, but also at the enterprise and consumer level. All are becoming more technologically sophisticated, they're increasing adoption. So again, you're in a great position to really preserve dilution given how much capital and investment is available. But really to the crux of your question, the pros and cons of debt versus equity, this comes down to your philosophical view and vision of your company's growth plans. Equity is flexible as it takes on more risk to help fuel growth of your business. And as a result, equity capital will take a share in that upside potential that is really helping the founders create. So in many ways, equity can help accelerate your business plan, especially in the earliest stages of your business. Now debt, depending on the stage of your business, is materially less dilutive relative to equity. And the focus of such type of financing, Matt, as you alluded to, is to get paid back with some form of fixed return, be it warrants, interest, or fees. So at the early stage of your business, it can be difficult to be debt financed due to the risk because debt needs some form of collateral to give it confidence it can be paid back. This can be revenues or cash flows, which allows a lender to prescribe value against your underlying company, or accounts receivable, which are really driven by sales. So if you're a bootstrap-focused founder, not really looking to shoot the lights out per se and call it a lifestyle business, procuring solely debt financing without equity when you can will be and may be the most appropriate solution for you.
Right. And I think it's easy to say it's really hard to collateralize a vision for a product that hasn't even been built yet for an MVP, right? I mean, there's got to be something tangible for a lender to be feeling comfortable lending that money out because, as I said, they're not really in the business of losing everything that they loan out. They're hopefully going to earn a smaller interest rate on a fixed return basis based on the underlying value of the investment. So think about it like when you lend on a house, you have the house as collateral. That's a physical asset that you can securitize against the loan that you give to that, individual. But with startups, especially at the early stage, those options are just not really available. So equity is kind of the best and only option to go with besides some of the grants. And, we can talk about some of the other non-dilutive fundings, but let's just focus on the debt versus equity conversation. So great. We have the understanding of the pros and cons of each option, but let's dig into the pros for debt financing. Let's say after a startup raises their seed or their Series A round with a traditional VC investor or an investor group, how should they think about the pros of debt financing versus waiting till they become maybe a public company?
First, perhaps let's lay the groundwork of the debt landscape and players. There are really two forms of venture debt that you can take on as a founder here. As I mentioned, if you're bootstrapped, you're not looking to grow and shoot the lights out, you're really looking to preserve your dilution with taking on minimal amounts of equity, then it might make sense for you to call our friends at Espresso Capital or Vistara, for example. They're private debt funds. Their debt is more expensive, and they are looking for really equity-like returns. But as a founder, you are renting your equity to them. You are giving up your cash flow that your business is generating that would go towards investment in exchange for foregoing equity-like dilution. The other form of venture debt is where SVB plays, and that is on the back of your seed or Series A institutional rounds and beyond. And the key word here, Matt, is institutional. We can get involved as early as you being pre-revenue, building out your product market fit, but it's on the back of an institutional round, and we really complement the equity round in a less dilutive manner. So for example, let's say you raise a $10 million Series A, a venture debt provider like SVB, we can provide a check that's anywhere between 25 to 35% of the round, which can give you meaningful additional runway without diluting your equity. And this gives the founder options to further accelerate their growth and reach a higher valuation threshold on their next round.
So let's explain to the listeners and the founders out there why it's so important to have the institutional sponsor with their capital in the form of equity alongside of SVB. Why does SVB care so much about that?
Right. And again, it's because we can get involved with just an idea, with just a PowerPoint presentation, but we have relationships with these investors. We work with them on a variety of their other investments that they're investing into. And it allows us to know that there's going to be confidence that someone with deep pockets can prop up the business when things aren't going necessarily as planned, because let's be honest, and we'll talk about this probably throughout our conversation, that things will not always go towards what the plan is laid out in the onset of building out your business. And you need a like-minded partner to continue to support the business when things aren't going necessarily as expected. The other area is institutional funds. They're closed-end in nature. They allocate reserves to each investment that they make. And that gives us confidence that there's other forms of capital that will necessarily pay down our debt when there isn't that fundamental collateral that hasn't been established in that business, as you alluded to before, Matt.
Right. So those reserves, that safety net you look at as a lender compared to an angel group who is more like tourist capital that come and go on the hot deal of the month and may not necessarily be there when the company needs a bridge round or when they don't hit their next milestone, for example. Is that what you're saying?
That's correct. And we don't necessarily say that that an institutional investor must reserve X amount of capital against the investment that they have made and the company that we've lent towards or to. But it still, by very much so nature, when we do our due diligence, we ask the question, well, how much have you reserved? And whatever that number is gives us confidence that there's liquidity available, additional liquidity available if challenges do occur.
Right. That makes sense. And you talked about sort of the Espresso Capitals of the world, that private lender group, which obviously has a much higher IRR that they want to hit because of the people they're borrowing money from. They're not going to the window with the Bank of Canada or the Federal Reserve. Their cost of capital is a lot higher. So ignoring sort of that segment of the market, what's the main difference between bank debt financing and venture capital debt financing, which could come in many forms, even like convertible notes and safes and then term debt we can get into. But what would you say is the main difference for founders to understand between those two forms, bank debt versus venture capital debt?
Traditionally, bank debt financing is conventional in nature and accessible when your business is generating revenues and positive cash flows. So I think you have an average of 1.5 million or more in assets or sales to leverage it. Now, a typical bank financing product is a revolving working capital line. It's a great tool to bridge between when you're waiting to be paid by your customers and you need to pay your employees, for example, payroll or your vendors. And you get such type of financing either from your contractual recurring revenue or your accounts receivable. Venture debt is really a tool to save dilution and extend your cash burn runway. It's agnostic of how the capital is used in many ways. And it's there to complement your institutional equity round and to be less diluted than more equity dollars. Now, as for safes and convertible notes, the difference between venture debt there is that they're quasi-equity in nature versus, again, venture debt. Venture debt ranks higher in terms of payment or liquidation scenarios. It's an actual form of contractual debt. And again, safes and converts, really, that can be a topic in and of itself. But as a founder, I suggest you really keep it simple, have really one issuance if possible. And can venture debt be paired with a safe round or a convert round? The answer is yes. So long that, again, it's with an institutional investor like Ripple, and we rank ahead of those types of investments or securities.
Right. The way I kind of explain it to founders is like bank debt financing. You're right. It's for typical businesses that are buying inventory, manufacturing, or offering some service, and then get paid on a net 60 or net 90 type of time period. They need to have that revolver to get through that sort of investment early on in the company's sort of production phase. But with startups and tech companies, you're investing so much up front into human capital, into building a product or a service, and you don't really see a lot of that revenue come till much later because you put so much money up front. You need some form of a hybrid solution, which is where the venture capital debt financing really comes into play. They understand the business models are a lot different than the traditional business models we had, maybe 25 years ago. And so that's where the need and necessity for a form of capital like what SVB provides is what we're talking about that founders are now taking advantage of, right?
Correct. Yeah. The last thing you want to do is use your short-term debt for long-term investment, right? You want to make sure that the mindset of either the equity or the debt is long-term and you want to pair it up with that form of capital or that form of investment.
That's really important to hear. Do not use short-form debt for long-term investments, right? Is that what you're saying?
Correct. Please don't do that. Anybody.
Yeah. Make sure all the founders out there understand what that means. Explain that in common English, because that's a really important point.
Right. So as I mentioned, the working capital line of credit, short term, it's meant to wait till you get paid by your customer so that you can pay your short-term suppliers. You don't want to use and as a result, you pay that loan back very quickly. So you want to make sure that whatever investment you're using the dollars to make, the term of that dollars, i.e., let's say it's equity, which has infinite amount of time, or debt, as the maturity, the repayment of that matches the investment you're looking to make. The last thing you want to do is invest in building out a warehouse and use, which can take many, many years to do, and use short-term debt, which you got to pay back in 6 months, for example. You can put yourself in a really big bind.
Absolutely. And we're going to talk about sort of how to align the use of the debt financing and the time frame you have to pay it back with the investments you want to make into your product or service in the sort of 6 to 12 month time frame. But first, let's talk about sort of a realistic example. So let's say you're a tech startup, you just raised 10 million in venture capital funding for your Series A. Should you also consider adding on debt financing? And if so, what kind of questions should you ask yourself if it's even necessary after receiving such a large equity financing?
So again, venture debt gives you the added optionality as a founder as to when to position for your next raise. And that can be meaningfully accretive to your equity. And the key word, Matt, is optionality. And ultimately, what does that optionality cost you relative to other forms of capital that you can get? Now, important questions you should ask in terms of whom your venture debt provider should be. Who is the type of debt financier you're partnering with? What's their track record in this space? What their motivations are. For example, are they a pure financial partner? And do they share the same vision as you and your equity investor? And will they work with you again when things don't go as planned? Or are they using their debt to gain other forms of business? The tenure of the institution is also very important. How core is the product or the venture debt product that they're offering to you within the actual institution itself? Meaning, is venture debt all that they do, or is it a small sect of the larger institution? And I really think culture of your debt provider and the respective experiences that they have in terms of their team and what they possess is an important element as well. A financial partner is a partner nevertheless, whether it's debt or equity, and unique perspectives to your business by virtue of skill sets and experience can be a massive value add to your business and to you as a founder.
Got it. So you want to make sure you understand who the partner is. Do they offer value? Are they maybe focused on your segment of the market? Can they be more than just a financial partner? Those are some of the questions you want to ask even before considering. So let's say you get comfortable with all of that. Then what do you think the next sort of questions you should be thinking about?
You can think of the terms of the debt, right? What's driving the size of the facility? What makes the debt available? Is it a formula, which is sometimes called a borrowing base? Is it determined by a multiple of revenue or cash flow? Or is it simply a function, again, like venture debt, of how much equity is raised? You also want to know the structure and term. For example, is the loan interest only? And for how long and when does the loan start to repay? Again, this is important from a business planning perspective. Is the loan committed or in demand? For example, at SVB, we only do committed loans, and that means we're conviction lenders. We can't just pull the loan away from you on demand. Obviously, that's subject to you being on side with your loan terms. Some banks during the at the peak of the pandemic, they were pulling their loans. And you also want to know what kind of financial covenants are available to you. And do you have to maintain a certain level of cash? Is there a minimum amount of revenue that you need to maintain as well to be on side with the terms of any loan or even venture debt loans?
Yeah. I mean, like when it comes to equity financing, I have to say it's pretty straightforward. We've seen some pretty complicated term sheets, but for the most part, it's pre-money, post-money valuation, expected dilution, ESOPs, things like that. Sometimes with the preferred share versus common share waterfalls, pref stack, things like that, and liquidation events and all that. But when it comes to debt financing, it often is very confusing with the terms and structures used because, first off, not a lot of people have a lot of experience in taking out loans besides maybe taking out a mortgage for their house. And they don't necessarily come from the, capital markets or traditional financing environment. So I would love if you can explain to the audience what sort of terms and structures and gotcha clauses should they be looking out for? And what are the main things that they should just sort of look at for red flags?
Yeah. So the red flags that I want to stress again is you want to know if the loan is committed or if it's on demand. Committed meaning that the money will be available to you when you need it, right? So long as you're on side with terms. Gotcha clauses, I would say in this market, there's not a lot. There's something called a material adverse change. And you really need to iron that out and have a deep conversation with your lender of what they mean and how do they interpret that. And if they've ever pulled this clause. And what this really means is before they funded you, they could say there's been a material adverse change. And could be the market environment, could be within you as a founder and how you're operating your business or the industry your business is in. And because of that, they do not want to fund your business or will not fund your business. It's very rare for these clauses, call it, to be pulled, but it's something you should really get comfortable around as well because it's very vague in nature. And when you're negotiating these types of facilities, make sure you have a proper lawyer on your side. You want to make sure that any ambiguity or any concept that is not clear and as a result is vague needs to be understood by you as a founder, so that there are no gotcha clauses and there's no surprises ultimately.
Yeah, the MAC clause, material adverse change clause for founders out there is very, very important to focus on. Definitely have a qualified lawyer look at that, very closely. But maybe Shez, give some examples of where you've seen MAC clauses enacted and where it may have been like a downfall of a company because they didn't really take a closer look at them when they were negotiating it without naming names that founders can kind of reflect on. So
I would say it really was the height of the financial crisis where I saw them mostly pulled. And during the pandemic, actually, this is when companies, in times of uncertainty need capital, any form of capital, but particularly debt capital, because in uncertain situations, you have an equity investor come in and really dilute you significantly. And that's when you need debt, really sometimes in the most uncertain times. You want to make sure that in these, call it left tail events or events that really catch you by surprise, your financial partner, your debt financial partner is there. The other thing, actually, Matt, I want to mention when it comes to venture debt is a lot of these facilities are broken out that match the milestones of your business. And so when you're negotiating these facilities, you need to make sure that you're aligned and you fully understand that the milestones are mutually agreed upon and that when you meet those or when you're not meeting those, you know that you'll have that money available to you at that specific point in time. So for example, let's just say you've got a $3 million venture debt facility. $1.5 million is available to you the day you can draw on it fully. The other $1.5 million is available to you when you meet certain milestones. And that could be you hitting areas of your product market fit build out, could be on a specific product SKU, launching that successfully, could also be on your just growing your revenues, plain simply. And so you should really be aware that those are the milestones you really need to hit by this specific date for you to access the other piece of a venture debt facility.
Yeah, so milestone-based lending is something people should also be aware of as well. But you mentioned before during like the financial crisis and the pandemic, when there's blood in the water, there's a lot of predatory investors and people out there trying to take advantage of that. And they will dilute the crap out of your company in order to fund you with a bridge loan. And so what I always like to say, when the markets are really frothy and capital is flowing everywhere, everyone goes towards the equity side of the equation. And when stuff is not looking that great and you don't want to take a 50% hit on dilution, you tend to default to the debt side because it's the less dilutive side of the equation. But how should, in this market, if equity investors are saying, we'll just give you the more equity where you don't have to take on venture debt when times are good, and you look at that dilution as not really that much and you're getting a great valuation, how should startup founders think about just taking equity blindly versus maybe a better way to assess the reasons for taking the debt versus equity financing when both options are available, especially in this market?
Well, I think there's a fundamental issue if you're going to take capital blindly. The dark reality, as we've mentioned before, is being a founder or a builder is that typically nothing goes to exactly what is planned for. And so, if you're going to take a massive equity check and that comes with that massive valuation and there's a hiccup on your business journey, and believe me, there will always be a hiccup, there can be a really, really costly down round to you on that. So there's a benefit of venture debt to protect against such situation as well. But ultimately, if your cash runway doesn't get you to a spot where you need to be with just equity, or if you have an idea that requires incremental dollars that can land you more customers, you can prove out your product market fit and continue, allows you to invest more in your product, again, add your product SKUs, or get a critical hire or team, I'd suggest speaking to a venture debt provider. And the benefit is because they're kind of the connective tissue between you as a founder and the investor, they can work with all stakeholders, again, you as a founder, your team, and the equity investor to come up with a mutually creative solution for you.
Yeah, I think that's absolutely right. I mean, a lot of founders we speak with are like, well, why would I take on $5 million of debt when I know someone will just give me $5 million of equity at a 4x the valuation I just raised at 3 months ago? That sounds good now, but you have to understand that valuation you just set for yourself, you have to backfill and you need to own up to it. And there's very limited room for slippage in that valuation dropping. But with debt financing, you have a lot more flexibility sometimes to make mistakes and not have to be feeling the pressure to hit that 4x growth target year after year. There are the pros and cons that we're talking about here that people should always be aware of. But one thing, Shez, a lot of founders we speak with, they often get worried about this, repayment of the debt side. It's this daunting thing that sits over top of them. And maybe it's because, they look at it like a mortgage, right? And that mortgage has to be repaid versus, an equity financing, which is a little bit more aligned with the founders and their own equity ownership and the outcomes in the business. So how should founders think about that repayment situation and how it may not be negatively viewed as much like a mortgage being, repaid and your home being taken away versus the benefits of the equity financing?
Yeah, I mean, it just comes down to knowing that you need to first pay back this loan at a certain point in time, and you have to live with that as a founder. There's pros and cons, as we mentioned throughout this conversation, of debt versus equity. Equity is more flexible. Debt is not as flexible in that you do need to repay it at a certain form of time. So you need to make sure that when you're building out your business and you're planning for your liquidity and your investment, that you know that this debt does need to be repaid at some form. So manage your cash flows accordingly, manage your business accordingly, and really know that you do have to pay back this loan. Just like when you get a house, you're not as free as you used to be, right? You have that obligation. But again, it allows you to really build out your business and give you, the key word again is optionality here. And that in and of itself gives you some form of flexibility.
Absolutely. I mean, yes, the benefits of owning a house are great, but there's also the risk and the pressure it comes with. And so just making yourself aware of that and understanding all the nuances and the negotiations of the terms and stuff is important for founders to understand. But let's get into the specifics here. A lot of founders look at all debt in the same way, but the two big forms of debt are actually term debt versus, revolver or line of credits. Firstly, can you explain the main differences between these and what are the benefits and the costs associated with each one so founders should consider?
The line of credit, which you mentioned before in our conversation, that's more short term in nature. That allows you, again, to bridge between you being paid from your customers and you got to pay your vendors, your employees. Very, very low cost because it's, again, a portion of financing your receivables, right? You know that you're going to get paid. You're just really taking risk of who your actual customer is, not you as an underlying business ultimately there. That's very, very low cost financing, sub 5%. A term debt is more longer term in nature. Again, a very conventional form of bank financing is really used to help invest in your company. But again, when your business is more established, you're generating cash flow in nature, and it's a term debt is usually established as a multiple of the cash flow that you're building, that you're generating as your company. So if you're pre-revenue, if you're burning your cash, it's very hard for you to have term debt in your business because cash flows ultimately pay down your term debt. It's longer term in nature. It's going to be higher costs. It could be anywhere between 4 to 6%, depending on the stage of your business, the size of your business, in a variety of matters. Again, more conventional type of debt. Venture debt is more expensive in nature, but less expensive than, let's say, the private debt funds who have a higher cost of capital ultimately, because again, it's being paired with your institutional equity investor. It's anywhere between 4 to 6% with some nominal dilution. But the dilution that's there is really, really, again, accretive to your business. So if you're going to give up 100 basis points in dilution, you're ultimately saving with venture debt anywhere between 5 to sometimes 15% in your ultimate dilution. So it's a pretty meaningful trade-off.
Right. And so it's really important to have, for us at least, a conversation with our founders about modeling out the different cost of capital options versus debt and equity and the dilution expectations you're going to get with equity versus debt. A lot of founders, come to us who have either other institutional VCs or angel investors on their cap table that have never done this modeling out of what dilution expectations should look like and the cost of capital between these two options. And it typically falls on us at Ripple to build that sort of model for them and help walk them through the scenario planning. And that's something a lot of people don't understand about what your institutional investors bring alongside of their expertise and strategic value is just helping simplify all these complicated offerings and terms to you, which is again why firms like SVB look to Ripple and say, if Ripple is involved, we know they've put their due diligence hat on, focus on the details and understanding of what it is they're offering so that the founders are aware of it as well. Right, Shez?
That's exactly right. And we're more than happy to work with all stakeholders and all parties, founder, investor as well, and also go through the minutia and say, hey, let's structure something all together. Let's go through the various business planning scenarios or scenario analysis that we need to go through and compare what is ultimately the best structure to come up with to fuel the growth of your business.
Yeah. And one thing I think we'd love to hear your thoughts on, Shez, is a newer trend we're seeing in the market these days on the lending side, which is this revenue-based lending model from the Clearcos and the Pipe.coms. How are you guys thinking about that? How should founders think about it? And what would you say the biggest differences are between that type of lending versus what the venture debt world is doing with Silicon Valley Bank and such?
So again, I would say that type of financing is more, it's very expensive. It's almost the same as equity. You're not giving up your dilution and it's not as flexible. So you're not necessarily diluting yourself, but the question is are you growing as a company, as a business with using such form of capital? It is very friendly, but it comes down again to your philosophical view of how you want to build out your company. If you want to grow rapidly, gain market share in advance of what your own expectations are, those models sometimes don't inhibit you to reach those thresholds because it's not necessarily the right form of capital to invest in your own business. It's more short-term in nature. When it comes to venture debt and institutional equity, the alignment is really there. It's there to help fuel the growth of your business. If you're looking for a land grab to acquire customers, if you're looking to build out your product in a fast manner, then you got to use longer term capital like venture debt.
Yeah, I think what I always try to explain to founders is you have to understand where the underlying sources of funding is coming from. Like, what's the starting point at which these people's businesses are determined to be successful or not? in order to understand what you're actually going to be charged for it. So for example, if you're going to borrow from Bank of Canada or the Federal Reserve, it is the freest money you can find right now out there. We know that's the source of capital. Therefore, the hurdle rate, the internal hurdle rate that they need to see return on is very low. And as you move up the stack, going from tier one banks in Canada to chartered banks in the US, to then third-party lenders, to then startup lenders, you can only imagine how the spreads get wider and wider, right? So maybe explain to founders how that actually is considered when you're taking money from a clear co on where their sources of capital are coming from to lend out versus where a Silicon Valley bank sits and then sort of the Federal Reserve chartered banks get their funding from.
So we'll start with Clearco and look, their capital is predominantly, it's not deposits, right? It's third-party investors. Those investors require a return on their dollars. Call it, let's just say 8%, which is similar to Ripple's cost of capital to some degree. So Clearco needs to then generate a return in excess of 8%. So they're going to charge you more ultimately. SVB and many chartered banks, our cost of capital is actually deposits. We all know deposits, you're not getting paid a lot on your deposits right now, but that's our form of capital. We then take that money and we lever it ourselves. And because it's by virtue free, it allows us to be very much so inexpensive relative to the third-party providers as well. And then also comes down to stability as well. You need to, not only do you need to know the sources of capital for each of the debt providers or financiers out there, but how committed is that cost of capital? So if you're dealing with a third-party lender, for example, and their investor can pull out at any point in time, then your investor needs to pay that their own investor back. Where are they going to get that money from? They're going to call on you to get their form of that whatever they've lent you or provided you back ASAP. So you need to be aware of that as well.
Right. I mean, this is why interest rates are so fascinating and so important to the overall ecosystem, even with, technology and startups being such a small part of the lending club, they are still determined by how much interest rates are changing at the very beginning of the line. So I say the reason I don't get paid high interest rates on the money I put in with the bank is because they don't charge high interest rates for the businesses that they're lending to. And hopefully those are some of our businesses, right? So it all kind of works hand in hand with each other, which is always great. But let's talk about some of the additional benefits of working with venture capital and private equity focused firms like Silicon Valley Bank on the venture debt side. And how should founders think about this when choosing which lenders to work with?
Yeah, it goes back to, again, their tenure and how focused they are in this space. SUB, for example, we're concentrated, right? We only focuses on the innovation economy, right? We're not going to finance a manufacturer of chairs or desks unless there's some sort of IP or technology that differentiates this chair to every other chair or desk in the world, right? So like Peloton is a client of ours, for example, because they were a game changer in terms of working out at home, and it's a completely highly differentiated concept and product ultimately. It's also how we build out our team. Ultimately, we're different from many other institutions where people have grown up and just done one type of lending their entire career. At SUB, our entire team is made up of those who are either former investors or who are operators in companies or are just deeply entrenched into the tech ecosystem. So the makeup of our team sometimes is the exact opposite of what, call it, another bank would actually hire in their most traditional form. So we're very passionate about technology. We love the ecosystem. We continue to support the ecosystem, and we've been doing it for 30 years. And we like working with early stage companies and founders and their prospective investors all day long.
One last question I'd like to ask you before we move on to our fast favorites round is, what are you seeing in the market now, especially in Canada where you're based, and where are you guys focused on or most excited about for the future of startups in our ecosystem here that we're developing in Canada?
What do we think of the market? We're cautiously optimistic. The investment landscape narrative has shifted a little bit in terms of the speed at which to get rounds done. We're very well aware that this is the first time either people have founded a company or the first time this is the first cycle in which people have invested into a company. And so we're excited because everyone's excited because things are going really well right now. And there's a lot of capital, there's a lot of founders. But what we need to be cognizant of is that the party is going to slow down or it's going to wind down at some point in time. And we all just need to be aware of, again, when things are not going to go as planned, how do we react to those situations? And is everyone well prepared for that type of manner? What's getting us most excited is, again, the element of risk taking as well. You're seeing people, tenured or individuals who've been at well-established companies, again, take a leap of faith. They're now working for an either early stage or growth-oriented company. In exchange for a comfortable, cushy salary, they're kind of getting more equity in terms of their future upside or compensation. And you're seeing more and more of this trend, this entrepreneurial spirit. And this is ultimately what's going to drive job creation here in Canada. It's what's going to continue to fuel the ecosystem. It's going to change us culturally as a nation. And that's really what gets us excited.
Yeah, I mean, I could only imagine how the game has changed for you guys as lenders when you have institutional sponsors coming into the early stage here in Canada, like Tiger and SoftBank and Andreessen and Sequoias of the world coming in to sponsor our companies, making your jobs a lot easier on the lending side to know that there are those deep-pocketed investors that are also betting on this ecosystem here. So it kind of has this full cycle effect on all the different things that we are getting access to now on the lending side as well as on the equity side. So we're excited about that as well as Ripple. Before we wrap things up, we always like to ask our guests for their fast favorites, where I list off 5 topics and you name your favorite one of each. So first one is your favorite podcast.
So podcasts really put me to sleep. So for those of you who are sleeping, you're welcome. And for those of you who are still awake, thank you. But for pure entertainment value, I really like the All In podcast. If those of you who haven't watched it, it's really entertaining. But it covers all things from economics to tech to political, social, and obviously poker. And you've got some the usual suspects like Chamath and David Sachs, who's formerly at PayPal, and David Freeberg, who's life sciences kind of healthcare entrepreneur. And so it's a really good group of individuals.
Definitely All In. I'm a huge fan. David Sachs is an LP in our fund too. So we're very fortunate to have him as a supporter. But I'm a religious listener and sometimes watching the YouTube channel when I can as well, because I always love to see their reactions to some of the comments that come out of people's mouths. Second one, favorite newsletter or blog?
Yeah. So I read Bloomberg and every day. Old school, if you want to call it, but I've been reading it for the past 15 years and covers everything from technology all the way up to just general world news. And their publications, quite frankly, are very interesting as well.
I would say that's the OK Boomer type of newsletter blog, but we'll let it slide here. Favorite tech gadget?
First, I'm not a boomer. It's my iPhone, hands down. The tool of productivity.
Absolutely. Favorite new trend?
Yeah, it's Canada's VC environment. We're just breaking record after record. Our quarterly fundraising volumes are the equivalent of what they were on a full year basis kind of 2 years ago. It's absolutely incredible.
Yeah. And we just wrote about that in the latest TechCrunch article that I was interviewed on with John Ruffalo and Damian Steele. And it's an incredible thing to see a lot of the attention being focused here as well. And last but not least, your favorite book.
So it's Most Important Things by Howard Marks. So before SVB, I was actually a turnaround investor. And now I'm actually, exposed to businesses that are worth $100 million and don't generate revenues. But this book really brings back the basics in terms of investment fundamentals. It has a lot of thought clarity around it. And it just puts things into perspective, especially when everyone's questioning how the momentum of this good market will continue.
Yeah, Howard Marks is the king of putting things into perspective, especially when things are looking very crazy and very frothy, when he is always the one who's trying to bring some logic into the world, which is great to hear. Well, this has been an amazing chat, Shez. Thank you so much for joining us in the tank today to discuss how startups should think about raising debt versus equity with managing partner at Silicon Valley Bank Canada, Shez Samji.
Thanks, Matt. Take care.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating as it helps us out a lot. And hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter at Matty B. Cohen or at Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,